With a shortage of property in New Zealand, the sections in high demand, I still see house prices rising, maybe about 5% over the coming year, at best, I'd say.
Which is still reasonably significant.
It's still significant, and it's going to be enough to leave most people thinking, okay, I think I'll buy sooner rather than later. Generally, we don't get house prices falling in New Zealand unless we are in recession, and the recession has been caused by interest rates rising sharply.
Welcome back to Tea with Tony. There is no recession in New Zealand. We explore what's driven the economy back into growth. House prices are still chugging, but for how long? And we've got debt to income ratios looming. I also asked Tony if we're walking past the obvious. But first, what are we drinking, Tony, today?
Yeah, well, I'm still sticking with my coffee, but I'll experiment with the tea again at some stage.
I don't actually believe you. Anyway, so we've got no recession in New Zealand. What does that mean for everyday Kiwis?
Yeah, not that much, because even if the economy had actually shrunk during the March quarter, all people like me would have said, it's old stuff, it's been and gone, we don't have to worry about it. And I would have focused within about 10 seconds on business confidence is strong, consumer confidence is strong, lots of houses being built and tunnels being dug, etc. So don't worry about it, there's a good outlook for the economy. So even the numbers the other day, they can be quite volatile on a quarterly basis. 1.6% growth over 3 months, that's not normal. There's some special factors in there, but underlying, our economy has growth. It's a good thing. It means jobs for people, wages eventually rising, profits for firms. Sounds like a fairly positive thing.
And links to a lot of the things that we talk about quite often, construction's going bananas, but challenges in the service side as well with staff and the like.
And of course the big thing is interest rates. I mean, for the past year I've been talking about if I were a borrower I'd be locking in 5 years because I see high uncertainty and inflation risks, interest rate risk, and of course now it's a matter of moment. I can see in one of my surveys people are moving a bit away from the 1 year fix towards 2 and 3 years, but of course now the banks are lifting up these longer term interest rates, so that's a big jump. So I'm looking forward to many months, if not next 2 years, talking about interest rate choices. It's going to be a big matter of moment now.
And there's that correlation to inflation, isn't there, with interest rates? So where do you think this is a concern for inflation or just more of the same?
Oh, definitely a concern for inflation. One of the key points I've been making has been that from about 15 months ago, central banks decided they would deliberately take the risk of cutting interest rates too far, keeping them too low for too long, generating too much growth and generating too much inflation, because they all know how to fight inflation. It's easy, you just raise interest rates. But if they'd not cut interest rates all that much, if they'd been relatively cautious, they could be back into a deflation, falling prices environment, and they've been wanting to avoid that at all costs. So the central banks have basically been planning to eventually have to scramble and catch up to inflation. And now that is starting to commence, and it'll run through this year and through a lot of next year as well.
Do you think that's a little sooner than everyone had expected?
I think it is, that's right. The Federal Reserve, for instance, in the United States, have been repeatedly saying, not going to raise interest rates till 2024, not going to touch them. And yet just a few days ago they said, maybe we'll increase 2 times in 2023. And our own central bank a month ago, for the first time since February last year, publishing an actual set of interest rate forecasts showing they plan raising interest rates 1.5%, affecting floating mortgage rates, from about the middle of next year. And now, of course, we've had news on the economy growing far stronger than people expected in the March quarter. And now the forecasters are bringing their forecast increases back in time to, we were thinking the second half of 2022. Now maybe they start raising interest rates in February next year. So things are speeding up at the moment on the interest rates front.
But it's crystal ball gazing, isn't it?
Yeah, I mean, people have to realise that before the global financial crisis, so 2008 to 2009, every time we saw inflation picking up in our economies, we economists would say, don't worry, it's not going to be all that much, and then interest rates would go higher than we thought was going to be the case. Every time since the global financial crisis, we've said, inflation's coming along, they're going to go this high. We were wrong the other way round. They only went to this level and then went straight back down again. So I'm not sure which way our mistakes will be this time, if we're under-predicting or if we're over-predicting. But that's valuable information in itself. Uncertainty is huge. None of us picked that New Zealand house prices would rise 30% when we have a global pandemic. So you have to realise that none of us really have a good model for picking how high interest rates go, how fast they get there, how long they sit up there, when they start coming back down again. So that's got implications for the way in which you borrow.
Well, I think it was the RBNZ or Treasury's own calculations for growth were much lower than, so it kind of speaks into what you're saying, that it's impossible to accurately predict anything.
Exactly. 4 weeks ago, the Reserve Bank was saying, we think the economy shrank 0.6% in the March quarter. Well, we grew 1.6%. That is a huge error in their forecasting. And all of a sudden, they're thinking to themselves, hang on, there's not as much spare capacity in our economy as thought. There's not as much labour, there's not as much unused machinery, and that sort of environment, it's going to produce inflation. We're just not sure exactly how quickly. And this is new. Businesses around the world haven't really dealt with inflation for a long period of time. And so it's going to provide a lot of challenges for businesses generally. But of course, for our interest here, it means the risk is on the upside for inflation and for interest rates.
So do you think for the everyday Kiwi, it might just make people feel a little bit better?
Most people I don't think would pay all that much attention to the quarterly gross domestic product numbers. They're going to be looking at what's happening around them, and of course what they see happening around is that the house prices are still rising strongly, the listings are still in short supply, the investors have pulled back for the moment, but I think some of that is temporary. I'm thinking in terms of some people might have, say, 5 investment properties, they're selling off one of them to reduce their debt, and then I can't help but think later on they're going to go, yeah, but I've still done well out of this over the past 10, 20, 30 years, and they will still be looking to buy a bit further out. So, people can sort of feel that housing pressure, I think, still sitting out there. We're yet to see the wages really rise, but every bone in my economist body says to me, when you've got companies screaming out for staff that they cannot find, there has to be a wages response.
There's house price growth remarkable in the last year. There's no other way to put it. No one saw that one coming. 30%. I just couldn't believe it.
Yeah.
So, is that growth going to continue, or, at what level? Is there going to be some sanity returning to the market?
Yep, sanity's definitely returning, and the market was already slowing down before the Reserve Bank brought the LVRs back in, before the March 23 tax announcements as well. And so those two changes there, I think, have reinforced the slowdown which was already underway. Prices simply adjusted so much so quickly because interest rates were at record lows that nobody expected. Term deposit rates at record lows after tax and inflation, you're going backwards. Also, we Kiwis thinking the 1 million Kiwis overseas, they're all going to come flooding back to nice, safe, COVID-free New Zealand. I'm going to buy a house before they do. So we've been doing this extra buying on that basis as well. One of the new elements out there which says to me that house prices are probably still going to rise in the next year, construction costs are increasing. Materials prices are going through the roof. The carpenters, the electricians, etc. Labour, it's already tight. I think it's going to get worse because there's a building boom in Australia, and we Kiwis maybe can double our income if we hop across the Tasman. And so we've already got Australian recruitment firms going around New Zealand looking for staff in the health sector, early childcare, aged care. It'll be happening for farm workers as well because they've had rain, so the grass is growing. And the mining sector also needs employees over there. So we're actually going to have a bit of a brain drain across the Tasman. It's going to be the opposite to what people were thinking. But with a shortage of property in New Zealand, the sections in high demand, I still see house prices rising, maybe about 5% over the coming year at best, I'd say.
Which is still reasonably significant.
It's still significant, and it's going to be enough to leave most people thinking, okay, I think I'll buy sooner rather than later. Generally, we don't get house prices falling in New Zealand unless we are in recession, and the recession has been caused by interest rates rising sharply. We're not looking at that scenario.
Well, look, from an NZHL perspective, I did a bit of a check-in on the numbers and with a couple of business owners. And after the March announcement on interest deductibility, we definitely saw a pause, which is what you and I have discussed previously. However, loan applications are back and cranking. We're on target for record loan numbers this year, and 20,000+ clients across New Zealand, so that's growing, and our business owners are run off their feet. One point in there, which is quite interesting, and we talk about this a lot, is that in the last session particularly, was that first-time buyers are sort of seen to be stepping back. We ran some numbers on that, and yeah, look, it looks like they might be sort of hesitating, same as your investors. However, I was standing in one of the Auckland offices yesterday and saw their board. First-time buyer, first-time buyer, first-time buyer, first-time buyer, they're there.
Yeah.
They're definitely there. And that might have been an anomaly, but we had the same experience in Christchurch. So hugely buoyant market still. And that FOMO, there's FOOP and there's FOMO, isn't there?
Yeah, that's right. The fear of overpaying for the prices. Yeah, I'll get a new gauge on that fairly soon. But yeah, the first home buyers are definitely there. Now, the data from CoreLogic show that since about 2007, 21%, I think it was 20.7% of property sales go to first home buyers. And earlier this year we were looking at 21, 22%. In April it was about 23%. So although we have seen many first home buyers get a bit hesitant, but not as hesitant as the investors, their share in the market is going up at the moment. So that's going to be pleasing. Frankly, to everybody, not just the government and what they want to achieve, but I think for all of us in terms of our own offspring and them buying eventually, we want young people to be able to buy a house if that's what they choose to do. And I think things are moving in the right direction there. And one of my other surveys, I can already see some of the first home buyers, they're starting to step forward again. Some of them are looking at new property, but of course they're facing competition from the investors who are incentivised to buy new property. And so that means the first home buyers, I think in the next few months, those that have been looking at a new build are going to switch back to the existing housing stock.
I want to talk a little bit about debt to income ratios and what that actually means.
Yeah, okay, debt to income ratio, basically, if we look at Ireland, in Ireland, a bank can only lend somebody a maximum 3.25 times their income. So if the person's income is €100,000, they can only lend the maximum debt of €320,000. In the United Kingdom, I think it's 4.25 times, so that'll be €425,000. In New Zealand, I recall a few years ago, we were saying maybe it's 5 times in New Zealand, we don't know. The Reserve Bank has talked about 7 times. That's pretty generous, but maybe it just reflects the high debt you're going to have to take on in New Zealand. Now, the Reserve Bank will get the ability to restrict lending on the basis of the total volume of debt somebody wants to take on. But I don't see them exercising that ability when they officially get it until maybe the next cycle. We can already see that the housing market has slowed down. When I look at the numbers, I struggle to see risky bank lending out there, quite frankly. We've got the LVRs back in place, so that's sort of calming things down. And of course, we've got the interest rates starting to go up. So I don't actually believe the Reserve Bank will be putting the DTIs in as a restriction. It might not be for 3, 4, 5 years. But it is a tool they will look to use down the track. But first of all, they'll change LVRs. That's what they've said. LVRs, they'll continue to move those around, and the DTIs, that will supplement them. Now, having said that, at the moment, the banks in New Zealand are trying to, what we say, get ahead of the curve. They, in fact, for the past year, have been putting in place particular lending policies which are not the minimum required by the Reserve Bank. One large bank in particular, they were requiring a 40% minimum deposit from investors, 6, 9 months ago. And now we see 1 or 2 of the banks already applying DTIs themselves. In a way, this is positive. We've seen this happening for a number of years, and it meant that going into the COVID-19 shock, we didn't have a lot of risky bank lending in New Zealand. It's one reason the housing market was strong.
Well, it underpins the overarching stability of the system, doesn't it? Yeah, and it can be really difficult for, we work in that space and clients to kind of understand that, but it is about protecting them as well and doing what's right and achieving good client outcomes. I found it really interesting your point about time down the track. This is going to take a while to play out because that's not very clear when you read about it. First home buyers have been ring-fenced and protected supposedly by debt to income ratio movements, but what does that mean? How can they do that?
It just means when you go along to the bank and you're looking to borrow money, and if your joint income, the couple going forward, is 100,000 New Zealand dollars with a debt to income ratio in place, then maybe the maximum the bank can lend you, all of your debt, credit cards, personal loans, delayed payment things, would be $700,000.
But the minister has indicated that he will let debt to income ratios come in, but he wants first-time buyers to be exempt, and that's I don't understand how that could work.
Yeah,
I would like to understand how
that's right. That's going to be the challenge for the Reserve Bank. It would give an instruction basically to the banks saying we're putting in place DTI ratios. Maybe for first home buyers it could be 7. Maybe for investors it could be 5. So they would explicitly, I think, look to have a difference like that put in place.
That's interesting too, because these are often lower income people. If we talk about the stability of the system, there's an argument to be had both sides there, isn't there?
That's the problem. When you try and move your housing market in favour of young people, you can end up loading them up with excessive amount of debt, and it makes your whole system quite vulnerable the next time a shock comes along. And we saw in the United States, the global financial crisis started in the United States with exceedingly bad lending to everybody over there. And that started from 1995 under President Clinton, when he issued some strong and strengthening instructions to the banks, to the Federal Reserve, etc. He wanted more lending to young people, to first home buyers, to try and get the home ownership rate up in the United States. It was his initial efforts from 1995 that basically sowed the seed for the global financial crisis. So these things can backfire. Did not work out so well.
And look, I find this interesting. We were talking before a bit of a are we walking past the obvious here? Now, what I mean by that is we've got little tools, we've got LVRs and we've got DTIs and, the new tax deductibility laws. Is that all just noise when you really consider what's driving the housing market growth? We all know what it is.
Yep. It's the interest rates falling to these record low levels, and not just the mortgage rates getting to these low levels last year, but also the fact that the bank deposit rates have gone so low that once you take off tax and inflation, you're losing maybe 1% per annum of whatever you've got sitting in the bank there. We've never seen that before in any of the interest rate or housing economic cycles in New Zealand. And around the world, it's encouraged investors to look at other assets. And so we are seeing in New Zealand and overseas strong demand for commercial property, strong demand for investment in sort of farming assets, strong demand for shares. We saw share prices bounce up straight away last year after they'd fallen. Cryptocurrencies, people are looking there, having a bit of a spec play
Although that's got a bit
as well.
ugly lately,
so
hasn't it?
that's up and down. It's not exactly a stable investment. And so while the interest rates still remain at very low levels, I think the housing market is still going to be strongly supported in New Zealand. But I guess this is where I issue a warning. The Reserve Bank is changing interest rates to influence the economy, to influence inflation. Whereas for the housing market, mainly they can move the LVRs and eventually DTIs, and they can do some things over there. If inflation does really start threatening on the upside, then they'll take the interest rates up to slow the overall economy, and there'll be a bit of a casualty on the housing market. This is some of the uncertainty that we're facing going forward. And that's one reason I've been saying to people, be careful just fixing 1 year in case the Reserve Bank does have to slap the economy 18 months down the track with quite high interest rates.
Because, correct me if I'm wrong, the obvious thing to do to fix the housing market is to adjust interest rates. However, that's not the single remit of the RBNZ, is it? So their hands are a little bit tied there.
Yeah. Our central bank, like other central banks, has to also pursue full employment, basically, avoid instability in the interest rates, the exchange rate, the economy overall. And now they have to try and produce sustainable house prices. That's very fungible, exactly what that means there. And so one reason interest rates are so low is because they've had to try and protect employment in New Zealand. If the Reserve Bank hadn't been required to try and sustain high employment in New Zealand, interest rates might not have gone as low as they did in 2020 and in 2019. And of course, you think, that's good to try and keep jobs in place. Yeah, but it's helped push the house prices up tremendously. So in the end, when faced with rising inflation, the Reserve Bank will raise interest rates to control the inflation, because they will ultimately be judged not on the employment and unemployment, what that's doing, by other central bankers, by IMF, etc. They're going to be judged on their inflation ability. And that's the warning I give people, that just watch for this upward surprise potential for interest rates down the track. The good aspect is people have got so much debt. Once the interest rates rise, we may pull back on our spending relatively quickly.
Right.
That's my hope.
Yes. Well, thanks, Tony. Thanks everyone for joining us again. Please don't hesitate to follow us. We're starting to build a bit of a following for Tea with Tony. Look, I do just want to add, like I do every month, that Tony is an independent economist. His views are his own and don't necessarily reflect those of NZHL, and vice versa. We'll see you next month.